What is QSBS? QSBS stands for Qualified Small Business Stock, which is an opportunity to sell certain stock tax-free, either the full or a partial amount of the sale. It can apply to shares of your startup, your closely held business, or in some cases even publicly traded stock. Here's what you need to know. First of all, it has to be the right kind of stock. There are three main rules. Number one, it has to be a C corporation domiciled in the U.S. Almost all publicly traded companies are C corporations. However, many smaller businesses are not. If you're unsure, this is the first thing to find out. Number two, it must have had less than $50 million in assets when you acquired the stock. And number three, it can't be a service business. Let's define this last point further. Think of businesses in terms of two types, service versus product. Congress really only intended QSBS to apply to the latter. So what's a service business? It's typically a firm or practice in the field of law, medicine, accounting, finance, architecture, and so on. The IRS way of looking at it is, does the output the customer receives rely upon the skill or reputation of the company's employees? For example, if you go to a consulting firm, you're depending upon the expertise of the particular consultant you engage. Different clients get different answers. That's a service firm. By contrast, a product business is defined as anything that's not a service business, whether it sells low-tech vacuum cleaners or high-tech computer software. Importantly, under the guidance offered so far, most technology companies appear to qualify for QSBS. Assuming you have the right kind of company, there are some personal requirements you must also meet, which fortunately are much simpler. There are three main rules. First, you must have acquired the shares after August 1993. Second, you must have owned the shares for at least 5 years. And third, you must have acquired the shares directly from the company. In other words, you can't buy shares in the open market and qualify for QSBS. If you meet the rules outlined so far, congratulations. You most likely qualify for QSBS tax treatment. So what does that mean? It means you get to claim a capital gain exclusion when you sell your shares, up to $10 million, or 10 times the cost basis, whichever is greater. The exact amount you can exclude depends upon when you acquire the shares. If you acquire the shares before February 2009, you can exclude up to 50% of your gain. If you acquire the shares between February 2009 and September 2010, you can exclude up to 75%. And if you acquire the shares after September 2010, you can exclude up to 100% of your gain from all federal taxes, including alternative minimum tax and net investment income taxes. Like always, there is some fine print to be aware of, all of which is contained in Section 1202 of the Tax Code, the full text of which is available on this site. Since the law is ultimately defined by how it's carried out, this site also contains all applicable QSBS case law, along with every relevant IRS private letter ruling. The site also covers what happens in special situations, such as when shares are gifted or inherited, if your company gets bought out, if you own your shares through a pass-through, when alternative minimum tax applies, and QSBS rollover situations. This site is the most comprehensive source of QSBS information anywhere. We invite you to take a look around, and if you can't find the answers you're looking for, use the About page to drop us a line.